走进纽交所，直击华尔街。在探讨经济危机的预测指标时，收益率曲线倒挂这一概念经常被提及。这种现象尽管对许多人来说可能听起来复杂，但它在经济学家和金融分析师中却是一个重要且被广泛研究的话题。简而言之，当短期债券的收益率高于长期债券的收益率时，收益率曲线便被视为倒挂。这在历史上常被视为经济衰退的前兆。在华尔街越来越认同2024年美国经济即将软着陆的观点时，被誉为收益率曲线之父的著名经济学家坎贝尔哈维却认为美国经济仍面临下行风险。那么，经济衰退先行指标收益率曲线倒挂多时，经济危机是否正在靠近？2023年美国消费者板块支撑经济，那2024年消费者支出是否会保持强劲？美国宏观经济又面临着哪些结构性的问题？本期直击华尔街栏目邀请到收益率曲线之父坎贝尔哈维教授来谈一谈他对于2024年美联储货币政策的走向，以及收益率曲线倒挂对于经济的预测性。Hello, Professor Harvey. Thank you so much for joining us today.
It's great to be on the show.
Can you use one word to summarize the overall performance of the U.S. economy in 2023, taking into account factors such as GDP growth, employment, and inflation?
Well, it's a hyphenated word, propped up. And what I mean by that is that 2023 was a pretty slow growth sort of year, except for one very important sector, and that is the consumer. And the consumer is 70% of GDP, and the consumer was surprisingly, to some people, resilient. But for me, it wasn't surprising at all because of two factors. The first factor was that there was pent-up demand as a result of COVID lockdowns. So consumers didn't spend during that time. They put off expenditures. And then when we returned to normal, there was a lot of spending. And a lot happened in 2023. And the other factor, which is equally as important, is the robust government support during COVID meant that there were a lot of transfers to consumers that added to their savings. So we saw these savings draw down in 2023, but it provided the growth that we saw. And again, some people thought that was surprising. It was not surprising to me. Looking at other aspects of GDP, it does not look nearly as good. For example, investment spending.
You mentioned consumer spending is very robust. So how do you think about the technology sector? Technology sector stock prices have gone up a lot in 2023.
So again, you need to be careful here because we're talking 7 stocks that did really well, that drove the performance of the US stock market. But if you look broader in technology, actually, there were a lot of layoffs in technology. So just because the stock market for certain stocks are going up doesn't mean that that goes into GDP directly. So again, if you look at the consumer was strong mainly because of the pent-up demand and the government programs. Investment was flat or negative. But more generally, the U.S. again is in a very good position because once again, in terms of technological innovations, they're the leader. And there's no dispute on this. So if you think about the innovations that are happening in terms of artificial intelligence or decentralized finance, this is the U.S. is well positioned to take advantage of those disruptions, and they are significant disruptions. Now, it might not go as planned, and one of the issues that could be a constraint is onerous regulatory environment that slows down these innovations or leads some of these companies to move offshore. So I think your point is that given the performance of certain technology stocks, that puts the U.S. in a good position, and I agree with that.
Do you think the robust consumer spending performance will continue into 2024, since a lot of post-COVID government assistance programs have ended nationwide in the U.S.?
So the answer is no. So it's hard to tell exactly when the savings run out. I was thinking the end of 2023 or the beginning of 2024. But there's a number of leading indicators that are relevant to kind of assess when consumer savings is running really low. And what I'd like to look at are delinquencies on things like credit cards and auto loans and general consumer loans. So you think about a credit card loan, to go delinquent or not to pay the minimum amount on your credit card, that's really costly. The interest rates could be 20%. So it must be that you don't have any savings. And we've seen an upturn in delinquencies for credit cards and auto loans. So that to me suggests that we're at the end in terms of the consumer savings.
So what are your predictions for the 2024 global and specifically US economy outlook? What factors are driving your outlook?
So investment spending is already soft, or even negative. And consumer spending, as I said, will likely run dry. And there's other factors going on. For example, tens of millions of people all of a sudden have to pay their student loans. And that restarted in October of 2023. And we'll see the effect of that. Another subtle factor is the credit conditions. And we've got this situation where interest rates are above 5%. So I can invest in a money market mutual fund and get more than 5%. But the savings accounts at banks, the rates are well less than 1%. And at the very largest banks, the rates are 0.02%. So what does that mean? It means that people withdraw their savings and invest in a money market. And as soon as you do that, it takes money out of the system that would be used for loans to companies. And this causes a credit squeeze that we'll likely see in 2024. It operates with a lag. And the final headwind is partially kind of a structural issue, and that is the commercial real estate situation, where you've got very large vacancy rates in the major US cities as a result of the work from home change. And that's what I mean, structural difference, that more people are just working from home. So that means that many loans will have to be renegotiated. Again, this will be pressure on the US economic growth. You also asked about global growth. Obviously, global growth is strongly influenced by US growth, but the US is not the only economy in the world. So if we look across different areas, Europe will have lethargic growth. They're exposed to other types of risks, geopolitical risks. And we're seeing also a slowing of growth in China. So, and I think it's important to analyze that slowing of growth. That we often see markets that so-called emerge and have robust growth in the early years of emergence, and then that growth comes down. And this is exactly what we saw with the US. So the US was once an emerging market, but once it matures, the growth rate moderates. And I think we're seeing some of that in China. And I think that it does play a role because China's external sector is so important. And this is yet another headwind for the US. So it's better for the US if China is growing at 10% rather than 5%. And it's better for the world if China is growing at 10% versus 5%. So I think that we do need to readjust our expectations there, that it's unrealistic and historically unprecedented to have growth near 10% for a very long time.
Right now, market consensus is that US economy will experience a soft landing. So are you predicting a soft landing, a recession, or a mild recession?
So this is the way I defined a soft landing. A soft landing is lower than average growth, and it does include the possibility of a mild recession. So we've had mild recessions. So think of 2001 was a mild recession. And indeed, if you look at year over year GDP growth, real GDP growth, it was never negative. It was just like very slow growth. So I am in the camp, and it's great that the Federal Reserve finally decided to stop their hiking of the short-term rate. I'm in the camp that we can potentially avoid like a hard landing recession and get away with either a mild recession or just lower growth. And that forecast is contingent upon the Fed reducing interest rates sooner rather than later.
What are your predictions for Federal Reserve's next move in terms of their monetary policy?
So I've been quite vocal on this, and if you followed my LinkedIn over the last number of years. So I'm of the strong opinion, and I think the Fed realizes this too, that they were too late in terms of increasing rates. So inflation had already taken a toehold, and the Fed was very late. As a result, they had to move very quickly. But I also have the opinion that they overshot. So they did not need to go to the rates that we're at right now, and that all of the hikes in 2023 were unnecessary. So my opinion is to get us back to where we should be, the Fed needs to slash rates. So the rate that I would like to see by the end of 2024 is somewhere in the range of 3 to 3.5%. And that's where they should have stopped in the first place.
In your recent interview with CNBC, you mentioned that recession is a self-inflicted wound right now. So can you just elaborate a little bit more on this? Why do you call recession a self-inflicted wound?
Sure. And it has to do with the rate policy. So there was no reason to go above 5% for the Fed funds rate. And what the reason that was stated by the Fed was, oh, inflation is above 3%. And that is based upon a fundamental misread of inflation. So inflation has many components, and the most important component is the shelter. So that's like homes and rental and stuff like that, 35%. And the way that that number is calculated is based upon an average of what's happened in the past. So if you look at the data today, you will see that in the latest inflation print, that the shelter component was going year over year, 6.2%. Yet that is completely disconnected from just casual observation of housing prices and year over year rents. So the surveys of year over year rents, they're negative. It's not 6.2%. It's like minus 2%. So the problem is that the number that goes into the CPI is stale. It's based upon inflation that happened last year. And policymakers should make decisions on important policies based upon data that's in real time and reflects the future, not last year. So for example, if we make an adjustment, we take that 6.2% and change it to something that is more reflective of what's happening today, let's say 2%, and I think that's too high also, then the inflation rate is 1.8. And it's been like that for the whole year. That's why I said you can't use the inflation excuse to continue to raise rates. So yes, this is a self-inflicted wound in terms of the downturn, the slower growth. All of this stuff is a result of policy that was made based upon a faulty interpretation of the inflation data.
So this is actually a risk that the US economy is facing because the Federal Reserve is using out-of-dated data. Besides this risk, what other risks or challenges do you think the US economy is facing in 2024?
Many people think that the Federal Reserve is there to kind of smooth out the business cycle. And I have a different opinion. So they add noise, and sometimes it is very, very disruptive. And this is an example of the Fed making things worse, not better. But it's not the only example. And let me talk about some kind of structural issues that will impact the economy going forward. So while I believe that inflation is 1.8% right now, I actually believe that there's a lot of stress in terms of inflationary forces that might take inflation above 2% in the future, in the medium term. And there are two forces that I'll mention, but there's more. One of them is underinvestment in climate. So we know that it's scientifically now well accepted that we're on a very bad path in terms of global warming. And the US and other countries just have not made the investments that they need to make to reduce the carbon output. And that is just like debt. And we need to pay down that debt. And that means that certain things will become more expensive. So a simple example is suppose all the oil producers had to cover the carbon. So that would dramatically increase the price of oil. So I can see things like that happening in the future. That's number one. And then number two force, and this is also an inflationary force, is deglobalization. So there has been a movement to do more stuff in the US onshore. So less reliance on certain countries, and indeed China is one of those countries, less trade, and this provides a headwind. So what does it mean? It means that if you do this domestically, it's going to cost more. And when things cost more, that is like an inflationary force, and that can reduce economic growth. So this idea of deglobalization, underinvestment in climate, I think it provides some headwinds for both growth and also creates difficulties for the Fed to achieve their kind of long-term target of 2% inflation.
How does deglobalization affect China? What is your outlook for China's economic growth in 2024? Are you optimistic or pessimistic about China's economic growth?
Again, a situation where if you look, and I have as an academic, I study economic growth globally. So it's part of what I do. And again, for China to move from like a 9% growth to a 5% growth, that's not unexpected. That stuff happens as you become more and more developed, growth tends to converge. So I do think that there is a runway for China to have this. The 5% is great. The U.S. would love to have 5%. Europe, they would be celebrating with 5% growth when they're kind of stuck at 1% growth. So I do think that there are some headwinds for China, and it's always good to kind of recognize what they are so that you can develop like a plan. So one headwind we've already talked about, this sort of deglobalization. And I do think that certain policies could be put in place to mitigate the extent of that. So I think that that's something that can be worked on. Maybe the political climate is tense right now, but it doesn't need to be going forward. So that's one factor. There are structural factors for China, and this is not just a China factor, but other countries experience this too, and that is the rate of population growth. So China made a decision in terms of the one-child policy that is going to affect the medium-term prospects. And also just fertility has gone down. China's not the only country. So you can see that happens in the US also, but the US kind of replaces the decrease in fertility with immigration. And other countries kind of do the same thing. So I think that also is a headwind. And again, that's something that policymakers should be thinking of. There are other issues. Obviously, if there are geopolitical risks, that impacts the willingness of people to invest in any country. So if the country becomes more risky, that just means that the hurdle for investing in that country goes up. Something riskier, you require a higher rate of return. Again, some of this risk can be mitigated by policymakers. And the last thing that I'll mention, and hopefully it's obvious, and I tell this story to all of the audiences across the world, that innovation is really important. So innovation is just like the driver of growth. And the US has done a really good job. So why is it that they are out ahead so far on all these innovations? So this is, again, not just advice for China, but advice for any country, that you need to have in place a policy that encourages innovation and to let people discover stuff. And most of those discoveries will turn out to be failures. It'll go nowhere, but you're looking for the big ones. And the big ones really drive economic growth. So I think that's really important in-house or in-country. Develop those capabilities to encourage innovation. It is the best way to grow. It's interesting that China and the US face a very similar sort of demographic problem, that with an aging population and government programs that's supposed to support the aging population, the money, it's not obvious that it's there. So this is why innovation is really important, that China needs to maintain that 5% growth rate. And the US needs to substantially increase their growth rate. The US Social Security will run out in 2033. So we've got like 9 years. And that is a huge liability. And we need to grow. So the US needs to grow, China needs to grow.
Our last question is about your expertise. We know you are the expert of yield curve inversions, and yield curve inversions have historically been seen as recession indicators. Do you believe that yield curve inversions still carry the same predictive significance as in the past? Because last year in 2023, yield curve has been inverted for a very long time, but was not followed by a recession.
Oh, okay. So this is important. So yes, this is my dissertation at the University of Chicago in 1986. So since my dissertation, there have been 8 yield curve inversions followed by 8 recessions with no false signals. So that is a very good track record. And yes, the yield curve actually inverted the 10-year yield minus the 3-month Treasury bill yield in November 2022. And there was no recession in 2023. That's a fact. However, the idea of the indicator is that it's a leading indicator. And if you look at all of the lead time to recessions, it varies. And if you look at, let's say, the most relevant, the last 4, the lead time is 13 months. So we're about at that. We're in the 14th month. So we're at the average. So it's way too early to say that the yield curve is not accurately predicting, because really on average, it would forecast a recession in 2024, and we just began 2024. So the other thing that's important is the yield curve slope, or this difference between a long rate and a short rate. That is predictive of economic growth. So it might be that we just slow down, and that would be consistent with the model also. So you ask whether the predictability could decrease through time, and that's a very deep question. And I've thought about it a lot, and actually think that I think there's some merit to it. And let me just briefly explain that merit. And it has to do with the so-called self-fulfilling prophecy. And what I mean by that is that given that the indicator is so well known, that people see the indicator and, oh, it's inverted. So that changes my behavior. So if I'm a company, I might not make a major investment because I want to wait. And this not making the investment, that actually decreases economic growth, but it puts the company in a stronger position if there is additional decreased economic growth. So what it does is it's like a tool of risk management. So companies are better prepared. And yes, there is this influence where it decreases growth, but it decreases growth in a way that you can avoid a recession. So think of it as kind of smoothing out the fluctuations because you're prepared. So you don't have to do a massive layoff. You don't have to go bankrupt. You're ready, and you can weather the storm. So yes, I do believe the predictability has changed. And oh, just by the way, I actually don't want a recession. So I'd be fine with my model having a false signal. That's good. Nobody wants a recession.